Hi James, hi Steve. Thank you for joining me for another DFM video update. To begin with, one of the biggest stories this quarter was of course the ongoing conflict in the Middle East, which culminated with the US launching airstrikes on Iran. Now that dominated global news headlines, but how did global asset markets actually react? And how were portfolios affected?
Well, there's been a general background of geopolitical unrest for the last couple of years, ever since the Russian invasion of Ukraine. The most recent one culminated in sort of 9-day air war between Iran and Israel, with the Americans getting involved, as you pointed out. Against that backdrop, there's been an increase in oil prices for fairly obvious reasons, in that neck of the woods is where most of the oil comes from and most of the oil passes through. About half of the global usage of oil and a significant proportion of liquefied natural gas as well comes from that region. So what the turmoil saw was just an increase in risk premiums more generally. So oil prices rose. They rose pretty sharply on the news that the Americans had bombed Iranian facilities, mostly because of the anticipated response from the Iranians. But the Iranian response was actually quite muted compared to some of the worst case scenarios, things like that. So you saw a very brief uplift in oil prices. I think they gained something like $7 in the day, and then things have dissipated since. There's still that sort of notion that oil prices are probably higher than it would be if these sort of background of geopolitical tensions wasn't there. So still a risk premium in the market, and that may well dissipate if we ever reach some kind of proper peace, say, in between Russia and Ukraine, and if the Middle East calms down too.
Were there any specific actions the Iranians could have taken which would have really escalated the situation?
Yeah, there were a number, but I guess the major fear was that the Iranians would interfere in the transit of oil through the Straits of Hormuz, which is largely controlled, or to a significant extent controlled by Iran. So about half of world oil usage and a significant proportion of liquefied natural gas comes through those in bulk carry via the sea. So there was a risk that they might interfere with the passage of that, or in sort of colloquial terms, close the Straits of Hormuz for one reason or another. So that was the major risk. But their response to attack a American base in Qatar, which sounds pretty combative, but it was very well signalled and very well dealt with. So it was one of the lower thresholds responses that the Iranians could do.
Okay, so overall, not too much effect on our clients' portfolios.
No, the significant background of geopolitical tensions does sort of drive that risk premium. We saw the risk premium expand during that sort of 9-day period, and specifically then. But so that risk premium is still there. I mean, it's probably true to say that energy prices would be lower if these geopolitical tensions weren't quite so conspicuous. So there is a sort of background influence, and that might be in, say, for example, might lead to longer term interest rates being slightly higher than they would be otherwise because of the high energy prices that feed through into inflation, that feeds through into interest rate expectations. So there's an ongoing influence which became much more conspicuous during that period, but it's still there.
And how have we seen portfolios respond to the kind of influences we were just talking about?
So Steve has previously mentioned that we've seen 7-8% moves in the oil price in a single day. However, elsewhere in global markets, equities across fixed interest, and alternatives in terms of, say, commodities like gold, price moves have been fairly muted during this period, and portfolios have held up relatively well.
Okay, so on to US trade tariffs, which were a focus of our conversation last time. What progress has there been on negotiations? Where are we up to?
Well, if we think back to April this year, Donald Trump issued a series of tariffs on different economies around the globe as part of his what he called Liberation Day, and these ranged from 10% on imports from the UK to the US, right up to 100+% for Chinese imports. He also instilled a 90-day pause on these tariffs. Because what we saw was quite a bit of negative sentiment from broad equity markets, global markets, towards these tariffs. Donald Trump, listened to markets, the 90-day pause effectively takes us to the 1st of August. So, and during this period, he's also threatened a series of other tariffs across Mexico, Canada, the EU, um, and also China. So, we're taking very much a watch and wait stance on this. Certainly, markets are as well. But there's the likes of the European Union and Japan. We're yet to see finalised figures there on tariffs. That said, markets have been holding up pretty well during that period.
Thanks, James. So, yeah, markets are holding up really well. But initially in April, they did fall quite dramatically. How did our portfolios get on in that time?
Yeah, so in terms of global, so if we take equities, the likes of the US stock markets, that fell, just shy of 20%. For us on the investment committee, that started to look a bit more interesting in terms of can we deploy more capital in that area. But fundamentally, nothing really changed in terms of the valuations of these businesses that we're researching. We saw the fall in asset prices, and like I said, Donald Trump reacted to those asset price moves and put this 90-day pause on tariffs. Since then, equity markets have rallied. In fact, we've seen the likes of the UK and US stock markets reach all-time highs. In terms of our portfolios, they've held up particularly well during this period. They've participated well in the recovery and held up well when asset prices came under some pressure.
Oh, that's good news. And our portfolios, they were reasonably well positioned ahead of time, weren't they?
That's correct, yes. So at our earlier rebalance this year in January, we tempered our exposure to riskier areas of equity markets, for example, US tech businesses, and enhanced our exposure to more defensive elements across the portfolios.
So US inflation is really under the microscope at the moment, with great implications for the number of interest rates we might expect to see this year from the Federal Reserve. What are market expectations at the moment?
So the expectation as it stands now is that the Federal Reserve reduce interest rates twice before the end of the year, so 50 basis points in total. You might have noticed a little bit of tension between the US administration and the Federal Reserve at this moment in time. And that's largely because Donald Trump wants lower interest rates, wants a lower Fed funds rate than is currently held by the Federal Reserve. But the Federal Reserve are fairly keen to hold off, just wait and see, because what they're looking at is the extent to which the tariffs are going to flow through into higher inflation. I think it's reasonable to expect some kind of inflation impulse. The question is, what will be the extent of that inflation impulse? Will it be one that takes inflation to a higher sort of trend rate than the one we're currently on? Or are we still going to see expectations for inflation to slowly climb back down to the target rate? So that's what a lot of tension is conspicuous between Jerome Powell and Donald Trump at this moment in time.
Right, okay. But the underlying US economy is still strong.
Yes and no would be the answer to that. I mean, we've come from a place in the sort of wake of the pandemic where the economy was very strong, both in terms of growth, high real and nominal rates of GDP, as well as a very tight labour market, so very low levels of unemployment, high wage growth, things like that. So from that sort of high point, things have cooled a little bit. So the extent to which the economy is growing is a little bit diminished, and the labour market, there are certainly signs underlying some of the headline data that do indicate that the labour market is less strong than it was. So there's a justification there for the Federal Reserve to reduce interest rates, which is precisely what you're seeing the market price in. The reason the market is pricing in lower interest rates is because of the weakness that it can see there. But it's also quite reasonable for the Fed to turn around and say, well, look, hang on a second. It's cooled, but it's not cool. And the rate of inflation is still significantly above target, and we've got this potential impulse from tariffs down the road. So it depends which you can see that from both directions.
So if that cooling of the labour market does indicate a slowing US economy, how might our portfolios be affected?
Well, in the short run, not too badly at all. I suspect that the slowing economy and the sort of slightly lower inflation impulse than a lot of people expect might give the Federal Reserve the grounds to be able to reduce interest rates. And if the economy doesn't slow down too much, which I don't suspect it will do if they do reduce interest rates, that looks pretty good from a equity investment perspective.
So we are positive on the US as a geography, but we're not overly exposed there, are we?
No, we're not. We've got material exposure, but I wouldn't characterise it as overexposed by any stretch of the imagination. So I've got a feeling that the equity market is waiting for lower interest rates to come from the Federal Reserve. So the sort of cooling that we're observing in the labour market and the slightly lower rates of economic growth will give the Federal Reserve cover to reduce those interest rates. So reasonably constructive on the US equity market at this moment.
So, James, over to the UK. What do we expect from the Bank of England this year?
Well, I think for this year, so for the remainder of this year, a similar situation to that of the US, that being two further interest rate cuts this year. So one in August and one likely in November later in the year. And that'll be two 0.25% cuts. So that gets you interest rates 0.5% lower than they currently are in the UK.
So the latest data did show a slight uptick in inflation in the UK. Does that change the outlook at all?
Well, in terms of the outlook for interest rates, so the Bank of England's quite forward-looking when making interest rate decisions. Latest figures on inflation show 3.6%, so that's higher than the previous figure of 3.4. That earlier figure was driven by increased energy bills, and we're also seeing underlying wage growth pressure within the inflationary figures. So there's still underlying inflationary pressures there, but that hasn't really changed our expectations of two further cuts this year from the Bank of England. In terms of interest rate decisions, the Bank of England appears committed to a gradual and cautious stance. We're interpreting that as one interest rate cut per quarter. And so by the end of this year, we expect interest rates to be 0.5% below their current levels. And we don't think the earlier increase in inflation in April's figures is any reason to expect anything else from the Bank of England.
So we're expecting two interest rate cuts for the rest of the year, which is good news. We do have to balance that against the likelihood of higher taxes at the autumn budget. Putting those two things together, what's our outlook for UK equities?
Well, so far this year, UK equities have performed well. The FTSE 100 has reached an all-time high of 9,000, and we don't see any real reason for that to change, as that market is underpinned by very favourable valuations relative to the likes of the US market. And we also incorporate smaller, more domestically focused stocks in our UK component. These businesses trading on even more favourable valuations. And we think these businesses may disproportionately benefit from those interest rate cuts.
So bearing in mind everything we've discussed, are we making any changes to portfolios this quarter?
At present, we're comfortable with the current positioning of portfolios. That's in terms of how we're reflecting the risks and opportunities across global markets. Portfolios have weathered the recent bouts of volatility well during the first half of this year. But we also made a number of changes in the earlier part of the year and also late in 2024 to reduce our exposure to areas of markets that look less favourable.
Okay, and final question. We've had some queries on Bitcoin. What do you think about the possibility of cryptocurrencies being included in portfolios?
Well, I think my answer is going to disappoint some, but reassure others. The prospects of us including Bitcoin-type investments, cryptocurrency investments in these DFM portfolios, which we regard as sort of core strategy, I think the prospect of us including those is pretty remote. Mostly because it's very difficult to actually arrive at some valuation for Bitcoin. Like, what should Bitcoin's valuation be? It's very difficult for us to do that, where it's much easier to arrive at those answers for assets that have cash flows associated with them. So gilts, for example, corporate bonds, equities, all these assets have cash flows associated with them. So you can incorporate various techniques for arriving at target values. You know, where's the current price compared to where the price could be, and also there's estimations for risk, which we find very important in the portfolios. We really want to manage risks as tightly as we possibly can, and that activity lends itself quite well to various assets, but not quite so well to cryptocurrencies.
Right, so that's a no then. But could they be suitable for any investor?
Yeah, I'm sure that there are investors for whom investment in cryptocurrencies is really quite valid. Yes.
Thanks for clarifying that. And thanks, James. Thanks, Steve, for joining me again for another DFM update video.